All right, this is being recorded. And I say this at the beginning of every webinar. Watch this again shortly thereafter getting this. It's going to take me a little while to compress it, send it out, and all of that stuff. It does take a little while. But watch it again relatively soon after this particular webinar because it'll help some of these things sink in. And this is really important during this one because of the fact that you're not going to be able to find this online or these rules anywhere else. So these are things that we used to do on the floor to kind of manage our risk when things started going awry. And that's going to happen. It doesn't matter what you're trading, whether it's options, stocks, outright stocks, or ETFs, any of that stuff. Our market prognosis isn't always right. Okay, the market will come to bite you. And sometimes we get beat on the probabilities. So therefore, how do we increase those probabilities of success? And that's what I'm going to be talking about here. Just little ways to stay mechanical and increase your probabilities. But let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started out trading my own money in college and trying to get a psychology degree, decided to switch it over to finance. After graduating with a finance degree, I moved up to Chicago and sold all my stocks, bought my first badge, the cheapest one I could get a hold of, and jumped into the pits and started trading from there. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all those products, excuse me, in all market conditions for the most part. I can't say every market condition because I haven't been around for like some of the crashes back in the 20s and 30s and stuff like that. But I have been in a lot of crazy markets. This says any opinions, news, research, and analysis or other information contained here is to be provided as general commentary and does not constitute investment advice. Because I don't know what's in your portfolios, you guys, I can't possibly give you financial advice. Plus, I don't know your risk parameters, which is even more so a reason not to give you investment advice. Bottom line is do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, you guys can follow me on Twitter at Wolfman's blog or on or our parent company, I should say, at ProTrader Strat. For me, you'll get daily market wisdom. Hopefully I throw out all my earnings trades in there because I usually do those after my morning market commentary that goes out to all our premium members. And then later on in the day, you might get some snark and other information that I find. Good to see you back in the house, Trevor. So you can follow us there. This is obviously for trades that have gone wrong, right? I mean, this is when, you know, it really takes some intestinal fortitude to step up to the plate, because one of the things we're going to do here is stay mechanical, and it's sometimes going to be a little bit odd because nobody else talks about it this way. Another thing is we can't avoid some trades going against us. And when you stay mechanical, you don't panic, okay? You might get a little nervous, but it's not like you're hitting a panic button, okay? I like to call it just pulling the ripcord. You know, you're free falling, you're having a good time, and then all of a sudden it's time to pull the ripcord and slow everything down. That's what this is about, pulling the ripcord or, you know, staying mechanical, staying focused on the end goal, which is to make sure that we are following some of these rules. Are back in AZ. Did you go to McCain's funeral? No, I was not invited to McCain's funeral. All right. So let's start off with simple. We just last week did the naked call and the naked puts. So, or maybe it was a little bit further away than that, and or the naked call spread and the naked put spread. We're going to be using the same process. If you're short a naked call and it goes against you, then we're going to use these same process as if I was short a naked call spread, okay? So we're going to try and keep it consistent there. So you don't have to learn a whole lot about that. And then we'll talk about the straddle and the strangle and iron condors and stuff like that too. All right, first, we're going to sell if tested or it goes into the money. Now, what I left that out there because I have so many things going on, call or put. It doesn't matter. If I am already short a call and I am tested, so assume everything we're talking about here is when we're being tested and when things are going against us. So when we're tested on this, if the break even is tested, and this is if you're one that has a lower risk tolerance and aren't willing to take on some of that risk, and maybe your market assumption has slightly changed a little bit. It's gone to a different level, and maybe it's gone above a Fibonacci, and now you're like, well, it's going to be hard to get back through that resistance level. If I was already short the calls, it's going to have to be something major. So I don't think it's going to come down there, but it might rest on that, which is now a support level. So when our break even is tested, or the short call or short put or short call spread or short put spread, okay, not to be confusing. I'm probably going to talk about this mostly from the short call side to make life easier. So we're going to sell a put if our call break even is tested or goes into the money. Okay, does that make sense? We would sell a put if our call is tested. Vice versa, if our put was tested, then we would sell a call. All right, and we're going to be selling the 30-ish delta, even if it goes inverted. If you wait too long, if you're like, okay, I'm waiting past my break even and it's into the money, still go and sell that 30-ish delta call or put, or, the short strike is at that 30 delta, even if you're going inverted. And the reason why is we're trying to lower our risk parameter by increasing our break even. So we need to collect at least at 30 delta to get a nice, decent premium in order to make it worth adding a little bit more risk to it, right? You guys always hear me. If we're going to add risk, we need to be given reward. So this is going to be adding risk. So therefore, around that 30-ish delta is the best risk reward area for trying to defend this, all right? So even if you have to go inverted, which means that if I was short the 100 call and it goes up to 110, and then I basically sell the 30-ish delta put, well, I'm going to be selling that put probably around the 105, maybe even 110 area, okay? So that would be getting us inverted. Now, yes, we will be locking in a loss if it comes down, but what we're going to do is play around with it so that our loss is going to land right in between there, and it won't be that great. It's not going to be as great as if it were just to finish there without selling that call or put. Does that make sense so far? I see people are blowing me up on the questions. Let me get a couple out of the way. Good to see you, Ted. We're finally on to defense. Yes, we are. And would you say call or put spreads? You're talking about credit spreads. Correct. We're talking about the only real way to defend an option strategy is when you have started this as a credit. Because if you've done it as a debit, it's really hard. You end up throwing good money at bad money by, say, buying another option or something like that. I look at it as you're like throwing good money at bad money. I would rather close out a debit type of strategy rather than trying to throw more debit at it. Does that make sense? If you are short a call, why short a put to defend it, and why not buy a call? Because great question. Great question. If you're short a call, why short a put to defend it? Why not buy a call? Now, that is a very good question, because at the end of the day, if I bought that call, for one, I look at it as I'm throwing good money, which is a debit, at the loser. And I don't want to throw good money at bad money in that way. But if I'm selling it for a credit, I'm collecting money. So that is good money in my eyes, all right? So we aren't necessarily changing our market directional assumption by selling that put, right? Because we can be directionally wrong and still make money by selling that put. Whereas if we buy that call and we're directionally, and then, you know, the market comes back, then we've thrown good money at bad money in a sense. Does that make sense, you guys? Because if you buy that call, you cannot be really directionally wrong in that sense as easily, let's say. Okay, so I would rather go in there and sell the put because my market assumption hasn't changed, all right? And all of this is really predicated on the fact that we haven't changed our market assumption, you guys. Because if we changed our market assumption, there's no reason to be in this trade anymore. Does that make sense? All right, good. And then, so, you know, you get these that are underlying. I don't know why that indent was like that with it. It should have been something else. I maybe should change that. All right. Or you can roll to a further duration. Now this or, like you could do that right away. You could take that short call. I'm short the call. It's getting tested on my break even or my in the money. And this is when it's getting closer to expiration. Let's say that's inside of maybe 15, 10 days. Now, you're not going to get a whole lot of bang for your buck there, but if you roll it out in time, then you're going to be able to collect more premium. That increases your break even again, okay? So roll it out in time for further duration. Now, you could do that if you just sold the call, roll it out in time, or if you've even created that strangle, you can roll it out in time. So it doesn't necessarily mean that you had to have created the strangle or the straddle. You can still roll this out in time if your market assumption is still the same. Okay, you could roll that short call or that short put out in time and collect a little bit more credit, okay? Or you can put the stock or called away, then cover it with options. And now, if you guys watch those daily market commentaries, you've seen me get stuck with a couple of trades here not too long ago. eBay was one of them, and I basically took the stock, and I'm now selling calls against it, doing a poor man's covered call. Now, if it gets called away and you don't have that stock, then you are synthetically, or you're not synthetically, you are actually going to have to be short that stock. You're borrowing stock. There's a lot of other things that go on with that, which is why I would rather than get my stock called away and be short those stock in my portfolio, I would rather roll it out in time, decrease my probabilities of getting that stuck to me, okay? So are we pretty clear on this with the calls and the puts? I've got some examples coming up here in a minute that I'll show you how we defend that. As a matter of fact, the problem with, you guys should understand how many screenshots I've taken in the past 5 years of trades when I do them and try to find the opportunity of having it as an example of how to do this in real life, and it never seems to work out. It's very difficult to do it. But if you watch the daily market commentaries, you get to see that more often. I'll assure you of that. It's not a lot, but I do have that happen sometimes. That would be a short straddle or strangle. Yes, if you added the short put or the short call to whatever was being tested, you would be creating a short straddle or a short strangle. And believe it or not, when it goes inverted, it's still considered like a straddle or a strangle, although it's inverted. But if the market comes back, won't the short put get killed? No, Trevor, because usually when we're doing this, if it comes back and it blasts through our puts to the downside, then yes, that would hurt. That would be like, why did I defend it? But I will tell you more times than not, if you're at that point where you are worried, and this wouldn't be for when you put this trade on and 2 days later you start getting tested on your break even, okay? This is after you're in this trade for a little while and it starts going against you. If it happens right away, I would probably try and hold on to it a little bit longer, hold on to my market assumption and play the probabilities. Because usually if we're selling a naked call or put, remember back to our rules, that naked call or put is about a 16 delta, which is only a 16% probability of being in the money by 1 penny at expiration, right? But remember also that little trader hack that I taught you guys, that the probability of being tested on this strike, or being, the market coming up and kissing my strike, is 2 times that delta. So it's about a 32% probability that I will be tested during the life cycle of this option. Okay. So, it's 2 times the probability. So when I get up there, if it happens right away, I'm just looking at it like, hey, this is blasted off way too fast, way too hard, and that's probably not when I'm going to do this. If the strategy was working out for a nice period of time and maybe bouncing up against a resistance level where you kind of put it and you saw that that was not going to work, and then all of a sudden it pops through. Now that might be a time where I'm going to start implementing this and being more mechanical, okay? This is when it's late in the game and your probabilities are really being tested, and it looks like this is the probability that is that 16% of the time that I'm going to get hurt on it. Well, that's when we start becoming mechanical. Alan, yes, I do always show the market profile. I trade the market profile, yes. All right. So we clear on that? So basically, for instance, I don't have one but this is the Tesla trade that I just did today that I talked about in the daily market commentary, right? So this is the 16 delta option, or it was a 16 delta when I sold it. So if the market, Tesla, starts rallying up here, that 60, I'm looking at it like there's a 32% probability that I am, during the life cycle in the next 43 days, that Tesla will rally up and hit 350. Now, if you watch the daily market commentaries, I'm not going to bore everybody with that right now, but the reason why I did that trade is because I have so many different resistance levels on the way up in Tesla that I would have to get through, right? Now, if it got up to my 350 in this case, and it was testing my break even, I probably wouldn't worry about it because I got another resistance area on this particular one. Now, if I was starting to get worried about it, then that's when, let's say, these become the 350 calls late in the game. So 43 days, let's just kind of fast forward 43 days. Now we're 15 days into it, and basically the market's coming up here and kissing me way late in the game. This is when I'm going to look to roll down and sell these 30 delta puts. So you can see that 30 delta on these would be a nice chunk of change. Now, yes, it's going to be hurting me when I'm seeing premium like that, but think about it. I'm getting another $6 for it. Okay. So as that being said, it's not going to be the 350s anymore. It's going to be, probably the probably the 330s or something like that. So I'd be short the 350 calls, and then I would be selling the 320 or 330 puts. Okay. And collecting that kind of premium with only 15 days left to go. So I've increased my break even to the upside again. And if the market comes way back down, I'm still looking at like, okay, well, I only have a 30% chance of being in the money here, or 60% chance of being tested. But now I've created that straddle. And in that case, with 15 days to go, if it last couple of days, it comes down here and peers through here, my market assumption is still the same. I think it's going to land somewhere in here. Then I would roll this out in time. Okay. Try and collect more credit, increase my break evens, therefore increasing my probabilities of success. Does that make sense there? Okay. All right. So iron condor or the strangle, right? It's, you can do with the straddle also, you're going to have to go inverted, which I don't like to do very often with the straddle, but you will get a lot of premium for that. Just make sure, and I'm not going to go over the straddle in here, just make sure that if you go inverted on a straddle that you originally started out with, make sure you collect enough credit by that roll that you can cover that distance in your inversion, okay? Why didn't you do a credit spread in Tesla to protect the short calls? because I don't like doing spreads. It has high implied volatility. It also, all those resistance areas. Do you see all those on my Fibonacci's there? All of these Fibonacci's, I was like, okay, what was it? Alan was talking about market profile. This was one of my theories, all right, with market profile being in here. If Tesla bounces off of this Fibonacci and starts rallying, okay, because I know this is a buy zone for a lot of people. If it bounces off of that, gets overextended, comes up, look at this. We got the value area low. We've got the next 38 Fibonacci level as a resistance. I've got the point of control where the most time and volume has been spent. That's where it wants to be complacent. So if it gets up here, it's going to be, it's going to start settling down a little bit, because where people buy and sell the most at that price, everybody is happy. When you're not making money and you're not losing money, you're complacent, right? When you're up a lot of money, all you can think about is trying to cover that trade, right? Unless you're mechanical, of course. But, and again, when it's starting to go against you, then you start getting a little worried. So I've got that going for me. I've got the 50 Fibonacci, which is another major resistance area. Then the 61, and then where the most time has been spent. So there's a lot of different things going for me here, Trevor, that I'm not really worried about. Plus all the news and everything else. I'm not worried about that. I don't like to go naked, only in the bathtub. Well, this, this is a perfect example of why, look at all those different resistance areas, that it's got to peel through. That's an arduous task in the next 40 days to get through. So I'm not too worried about it. All right. Okay. So defending the iron condor, the straddle. All right. Roll if our break even's tested. That's one of the first things we can do, is just roll it out in time. That is if our market assumption hasn't changed. For instance, in that Tesla trade, maybe rather than doing what I did, you wanted to throw a straddle around it. So you would have sold around that 16 delta if we're looking at the same one. I already have this up. So with Tesla, let's close this one. So we would set this up right now. So I sold the 11s on here. Believe me, I sold the 16. So let's just say 1, 2, 3. I would have sold the, where's the 16? 1, 2, 3. So I probably would have sold these 245s. Okay. And that would have been my straddle. So in that, the 245s are way down here, which I don't have a problem with. You're going to have that support. All the collection I would have gotten my break even below this 244, which is the 52-week low here. That being said, we could have come down here, tested that. I have a lot of room to the downside. I'm not worried about. Okay. Where are your fibs drawn from? So these are actually Fibonacci extensions. I usually make them in gold to differentiate it, but I didn't do it on this one because I didn't even have the fibs, but we can look at it on the 3-year chart, and you can see that I drew the fib from, where was it? From, maybe this wasn't a fib extension. I thought it was a Fibonacci extension. I took from here and then took that down to here, but I just took it from the 52-week high and the low, it looks like, on this. Is that good for you? Tesla gaps a lot. Yeah, especially with Elon Musk going off the rails lately. All right. So basically from this high to this low is where I took it from. We good with that? All right. So pop down here. I'm not worried about that. So I am more worried about, or not, I'm not worried because I'm long 2-year puts, but I am more bearish in Tesla than I am bullish. I don't think it's going to rally up there anytime soon. People are coming to market really quick and with really nice electric cars that I think is going to be a huge problem for Tesla going forward. All right. So the only way I'd be worried about those calls, to be quite honest, is if all of a sudden over the weekend, Elon Musk got booted by the board or something. All right, so roll the untested side to the 30-ish delta. So it's the same thing, right? When that call or put that I was talking about gets tested, we're still rolling to the 30-ish delta, all right? Obviously, if we got to go inverted, we're going to go inverted a little bit. But I would try, if I go inverted to get to that 30-ish delta, one thing I would start weighing back and forth is, am I collecting enough credit to kind of cover that gap now? It's not going to cover maybe all of it, but you will be able to get a nice little credit and maybe cover 2/3 of it, let's say. So, rather than on a iron condor where my rule is collect a third the width of the strike, so you're collecting 33 cents for a dollar wide, right? Well, if I came back down, I'd like to try and at least, if that 30-ish delta, I would try and like to collect at least to cover 2/3 of that, so another 30 cents, or, in some cases you can cover almost the full distance. So that would be something that I would be interested. Yeah, I saw the Mercedes-Benz one. That's the one that I was thinking that I couldn't remember who was just showed their brand new electric car, and I think I think it's Fissure or something. Fissure Karma is a sexier electric car than anybody's got out there. It almost looks like a Ferrari, like an older Ferrari. So in this example, let's say that we sold that, we would have to come down to try and sell that 30-ish delta. So if I'm being tested on this one, on being kissed on it, my probabilities are being tested, I'm going to be looking to sell somewhere right around this 30-ish delta, one of these two. So I still have on a straddle, or sorry, a strangle, but it gives me also room that if the market kind of starts moving the other direction, then I can start rolling these puts even tighter and tighter. If it continued to, say, rally, I've collected a bit of credit on these, then I could roll it into the straddle. So you can roll this several times. I like to go to the 30-ish delta to give me a little wiggle room if my market assumption hasn't changed. But if it continues to go against me, obviously, if the market moved a couple more, 10 points higher, I would have collected another couple of dollars, roll it again, collect a few more dollars for that, and continue to increase your break evens, okay? And then hopefully you've collected enough credit that if you need to go inverted, you can go inverted. But usually before I do that, if I'm at the straddle point, I'm going to look to roll that out in time if my market assumption has not changed. All right? Why do you use monkey bars? Interesting question. I use the market profile, monkey bars, and the volume profile because I believe that it is the psychology. It shows the psychology of the market. If you guys remember at the beginning, I went to college for psychology. And I believe that that psychology degree has done more for me than my finance degree in trading. But the monkey bars shows you where everybody's putting their money where their mouth is. And if you know where everybody's putting their money where their mouth is, then that's where it wants to go. It's kind of, it acts like a magnet, let's say, that the market wants to migrate back to that. All right. Once it gets overextended, once the people have puked out and everybody else is scooped in, then that's usually where you start seeing those turnarounds when it gets really overdone. And that's sometimes like you'll see my charts where I have the 100 extension right there, but I leave it on there because, it fits with the market profile and stuff like that. And I just look at it like, hey, it's gotten overextended to the upside. It's going to want to come back down. So I don't usually push those around. All right. Oh, what are monkey bars? Monkey bars. Okay. So I don't have a whole lot of time to go into this, but we do have, I have a video on this on how to trade it. So the monkey bars is where the time is. It's where the most time has been spent. And that's what those little dots in there are. They're actually little numbers. And on the floor, we used to use letters. And that's where the most time has been spent. So when people are used to seeing price, that's where they've accepted price. And the volumes where they're putting their money where their mouth is. Does that make sense? So the roll would bring the good side closer to the bad side. The roll would, yes, depending on how you look at it, right? The bad side's being tested even further than a roll further. Yes, you're rolling that one that has made the money. Now think about it. The one that you're rolling up closer to the short call, let's say, that one doesn't have a whole lot of money or extrinsic value left in it. So why leave that on? Let's be mechanical. Let's collect more credit. Roll it, collect more credit, increase our break evens. Okay? Get more theta decay. Does that make sense? You guys still with me? So roll the untested side to the 30th delta. And I do have examples, believe me, or believe it or not. All right. The other thing is, obviously, roll out in time to extend duration. When you're extending duration, you're giving yourself more opportunity to be right. Even with like the market profile, when things get out of whack, you know, you can see nobody wants to trade down here. Look at the last time Tesla slammed down here. It got overextended. There wasn't a lot of time and volume down here because price wasn't accepted. What happened? It snapped back, right back to the point of control. Yeah, somebody could say, yeah, it snapped right back to the 38 Fibonacci, which is what you would expect. Well, no, I think it snapped back to where the volume profile shows the most time and money. Now, it's not to say that if we go to a different level, like this market slams down to here and starts building this out, then people are accepting price at those levels, which is okay. And if you saw something like that happening, you know, where my puts were tested in this, I was short puts and I started getting tested and you started seeing this build up a little bit, then you know you're probably in for some trouble. That's maybe a time to start selling some calls for it because it's not going to come back if you start seeing price accepted. When you roll in time, you are delaying theta or delta. Delaying, you're not delaying anything. You're just you're capturing more premium, which is that extrinsic value, which is going to decay due to theta, right? So you're selling theta in a sense. You're selling that time decay, collecting the credit. You're not, you're reducing your delta directional exposure. Yes. So if I was short a call and the market went against me, my deltas obviously are increasing on my call side, right? Which is making me even more bearish. So when I sell those puts, I'm reducing my my short deltas, right? Because I've added long deltas by selling puts. All right. And if I lost anybody there, remember delta is negative for the put. So when I sell a put, a negative plus a negative equals positive, right? So that's positive deltas when you're selling put. And if I'm short these 16 delta calls, when the market's rallied, and I'm showing you a market, the market going up by moving my cursor down, right? Because the deltas are increasing. These short calls are getting closer to the money. The deltas are increasing to 36-ish in this sense, right? If we had a 25 or a $50 move to the upside. Okay, that's when I'd probably be looking to start selling that. Reduce my short deltas, yes. So here is an example, an old example, but of, is that the picture because I have my, I'm like, so this is exactly like my screenshot. My example wasn't Tesla. All right, so this is an example of when my market, I don't look at the break evens on when I'm being tested. I look at my strike being tested. That's how I stay mechanical. If you have a less of a risk tolerance or you're newer to trading, I have no problem with the break even. It's going to happen a lot sooner. But stay with it, stay mechanical, do the same thing every time. If you're doing it when you get hit on your break even, do it when you're hit on break even every time. For me, I do it when my strike is being tested, especially late in the game. This is what I'm talking about. 16 days to go. This market came up and started testing me. I only have 16 days. I'm not messing around with it anymore. Okay. So that's when I roll to the 30-ish delta. Now, I like to lean away from it, like less than maybe 30 deltas, but you could have gone a little bit closer for the extra 30 some odd deltas. And if you look at here, I would have collected another, let's say 22 or 23 cents for that collection. Now, if I followed my rules in the beginning, when I'm doing this iron condor, I would have collected 33 cents. So now if I collect another 25 cents for it, now I'm at 58 cents total credit. So now I've reduced my exposure by, 20 some odd cents in that particular one. And, that's if the market continued to rally and go against me. I only have now 40 some dollars in risk. Does that make sense? Originally, when I sell this iron condor, I collect 35 cents, 33 cents, let's say 33 cents. Now, my max profit is that 33 cents because I'm selling that credit. My risk is 67 cents for that dollar-wide spread, right? So my risk is 67 cents. If I roll this to that 30 delta at this point in time, I'm collecting another 25 cents, let's say. Is that right? That's a little steep. 23 cents, let's say. Collecting another 23 cents. So 23 plus the original 33 cents. I have a total of 56 cents now. So I've reduced my risk by that much. Now, if the market blasts up, I only have 44 cents at risk. Does that make sense, you guys, if it continued? And if it came back down and landed right in between, I'd get to keep both of those credits. Right? So this is the roll. I'm still getting tested on this one. I immediately roll to about the 35 delta or to the 39 delta. I got a little bit more aggressive than what I originally thought, probably because I wanted to collect that extra 33 cents, which is what it was looking like. I thought it was a little weird that I was thinking I was going to collect another 25 cents for it. So I collected another 30, let's say 30 cents. So I've reduced my exposure from, 67 cents to now 37 cents total risk on this trade, which is pretty good. And if the market comes back and lands right down here between the 35 and the 35 and a half or whatever, I get to keep both of those credits. All right, you guys have any questions so far? I mean, it's pretty basic. I try and make these things as basic as I can, break it down. Believe me, it took me a long time to figure out ways to teach this on the ways that we used to do it on the floor and come up with some rules to make sure that it was in line. Eric, with naked puts, do you at times take assessment or assignment of the stock and sell covered calls? Is that what you meant on the point number 3 to defend? Yes, I do. And Jeff, as a matter of fact, this is the deal. I do daily market commentaries every single day, and I talk about every single trade that I do, when and where I do it. I trade earnings as well. So I have earnings webinars out there that you can learn to trade for just earnings. But in my daily market commentaries, you guys, I go through all of this stuff. I stick to my rules throughout all of this to make sure that I am mechanical. And that's the only way to increase your probabilities of success, you guys, is to stay mechanical. If you start shooting from the hip and stop following the rules and try and, basically break from what my rules are, you guys are, you lose that mechanical structure. And when you're more mechanical, you stay more patient, okay? You realize the probabilities are the probabilities. It's not about the market being against you and Goldman Sachs hating me and stuff like that. It's really just about being mechanical and playing the probabilities. So if you guys want to trade like a professional trader, this is the thing you guys need to take advantage of. And 2 months for the price of one, great deal. You guys can see how I teach or I follow through with what I teach because I trade this way. I've created these rules for myself long before I started teaching it because, you know, I'm a recovering futures trader is what I say to people, you know. Trading futures is fun, but, you know, it's dangerous. Now I was like, so I got an epiphany and I was like, you need to be mechanical. You need to stick with the rules, because if you don't write this stuff down and you don't, you know, hold yourself accountable, by writing it down, you're holding yourself accountable. Right where you get in, right where you get out, write down when you know, rolled this strategy. Make sure you stay with that to be mechanical, and by writing your stuff down helps you do that. And I go through all of this stuff in the daily market commentaries. I teach you guys all of this and try to pound it into your heads. But yeah, I have, when you were asking about taking assignment, I'm long eBay. I don't love eBay for any other reason that I played it for an earnings trade and I got stuck with I got put to stock. So I'm long eBay stock and now I'm selling calls against it. So, and as a matter of fact, I'm inverted now. I think it was William that was asking. I'm inverted on my eBay trade because I'm long eBay at 36 is where I sold those puts, and I'm selling premium at 35. My calls are at 35, so I'm inverted. I've locked in a small loss if eBay comes back, but it's only like 30-some cents. I don't care. I'm being mechanical. I don't think I'm going to go much further inverted than that unless I can start covering more of that distance, right? But if the market starts coming back, when I roll, I'm going to roll out and higher and hopefully start increasing that distance that way. So yes, I do that on a daily basis, talk about every single trade. I don't cherry pick my trades. I have months where, just like you guys, things aren't working out and I fight through it. Stay mechanical. I'm up against the ropes. I'm going to battle my way out. I just know the probabilities are against me. So, you know, you guys should really take advantage of this. If not just for the daily market commentaries, I think it's worth it. But you also get not only those daily market commentaries, you get access to all of my videos. So if you're kind of late to the game and you missed some of the earlier, because this basically, we've started out from the most simplistic strategy with my rules all the way through, and now we're talking about defending. This is it. And if you guys have gone through this whole class also and learned these strategies with, you know, my course, you should definitely take advantage of this, because this will just reinstill this back and forth. Like I said, you know, go and watch this video again and again and again so it sticks to your long-term memory. I beat this into your head in these daily market commentaries. I'm going through it, and I can guarantee you I'm staying mechanical with it. All right. And online access to the top, the video archives. I mentioned 50 online trading workshop videos. You get also access to these classes, first access. And what's not mentioned here, you guys, I have a policy, a no inbox policy for my premium members. You guys send me an email, you're getting an email reply unless I'm on my deathbed or out of the office or something crazy. I'm going to try and get back to you as soon as possible, because I know that when I was learning to trade and when I was first starting out, that when I wanted an answer of what was going on, I wanted it right now. I didn't want to wait 2 or 3 days with that panic. So I'm going to try and get back to you guys immediately. And if I can't do it in an email, like explain what I want to say in an email, I will tell you, give me a call. I will answer the phone or give you my phone number and we will talk it through. So reach out to us at Trading at Pro Trader Strategies if you have any questions, and call us. Oh, shoot, the link. The link's in the chat window. If I send it out right now, let me see. Chat window. Yes, sorry. Somebody was asking how do I get this? You can pause this video if you're watching it on tape delay, the 2-for-1 deal, or it's in the chat window, which is much easier to just click on that. So what do you say? Go ahead and click on that. Take advantage of this. We'll get you set up with this. If you missed the whole course, I'm going to talk about these trades when I buy puts and I buy calls, or I sell puts, sell calls, spreads. I do all of those trades. I do have my favorite strategies, but another thing I teach is just because you have your favorite strategy, you should not be a one-trick pony, all right? Make sure you split it up and stay diverse in your strategies as well. So all of that stuff I cover in here on a daily basis. just about every single day. I try to do it every day, but of course, every once in a while, I might be traveling or something like that. So take advantage of that. One last thing I want to do is thank you guys all. And in later webinars, I'm going to be drilling down on different option components, when and where I find trades that are appropriate for me. You have to decide whether they're appropriate for you. And you can pause it again and hit on this. It's not a hot link that you guys can hit on. And I want to thank you guys for watching. If you have any questions, contact us at 310-598-6677 or email us at trading@protraderstrategies.com. All right, so that link is, like I said, in the window. Much easier to hit on that. But yes, you guys, even if you just started out, should take advantage of this. And, if you're worried about trading options, watch this. I go through every single trade. You'll be able to see what I'm doing and whether or not you think it's going to work for you. But definitely take advantage of it. So futures are gone and you mostly trade options now. William, I try to trade options specifically. Now, in my daily market commentaries, webinars and stuff like that, I don't talk about when I'm trading futures, even if I have a huge winner. I don't even put it out on Twitter. It's sometimes I'll throw on a couple trades for futures, but and I do it as small as I basically can because I want to stay involved in the market. That's the only reason why I'm doing it. I suppose these aren't live. What's that? The trades? No, but I do it early in the morning. Like I basically do all my trades in the morning. And if I do a trade in the afternoon, like I said, follow me on Twitter. I'll throw it out there. Hey, I'm covering this trade for you guys. Make sure you guys keep an eye on that. And then I do talk about it in the market commentary the next day. And, sometimes the next day it's been better, like if you would have waited a day, it would have gotten better. I don't look back, you guys. That's another thing about being mechanical. Never look back and say, God, I should have waited another day. I could have made a little bit more money. That's where you get yourself in trouble, right? You've broken the mechanics and you're like, I'm just going to wait. I can't tell you how many times I've seen people do that and watch them just lose the entire profit, right? If you pick a spot, write it down. Everything should be written down. I talk about that. I have, to my wife's chagrin, about 4 different spiral, actually it's more than that, it's like 6 different spiral notebooks on my desk from trades that I've done 2 years ago. I write them down, why I got into it, what the environment was, when I got out, if I did something to, be mechanical and play around with it, or if something changed my mind on my market directional assumption. All of those things get written down. And then when I got out, right? So that I have data to go back to make sure that my theory is still there, all right? Also, when you write it down, you are going to be more likely to stay with that original idea, right? If it's in your head and you're like, hey, I'm going to get out when it goes up to there, it gets up to there, you're going to be like, well, now that it's there, I'm going to let it go to there. Don't do that. Nobody ever buys all the bottoms. Nobody ever sells all the tops. I may have sold the top or bought the very bottom a handful of times in my entire 25-year career of trading. It doesn't happen. No matter how much somebody tells you they do it. It doesn't happen. Nobody ever sells that high tick or that buys that low tick. All right. I mean, I say I bought the, 2009 bottom. I didn't buy the very bottom. It was very close to the bottom, but even the stocks I bought weren't the very bottom. So, I mean, nobody ever does it. All right. So take advantage of that. And that's all I got for you guys, other than if you can't take that, take it easy. JQ, I caught him while he was trying to write something else. I did see a couple other questions going on. If you could have waited another day and made more money, could that mean that your mechanics were wrong? No, I don't look at it that way. My mechanics are, I get out at specific profit targets or specific levels. And that's where I decided at the beginning that that's where I was going to get out. So no, I don't look at it like, oh yeah, you were wrong. Well, no, I was right. I made money, right? All right, cool. Andrew, I hope you took something away. Good. Thank you. Do you ever go to expiration? Great question, Brian. I try not to, but if it's against me, I will. That's the only time I take anything into expiration. Is when the trade's against me. If it's not against me, I know I'm not taking it to expiration. I'm getting out. I don't want to see it turn around. And a lot of wanky things happen in the last 7 days of a stock option montage, because big money can push that market around a lot better than my little account, all right? Which I think is a pretty decent account, but compared to those boys, you know, I'm not buying 100,000 stock, right? They're going to push it to where they want, and I can do nothing about it. So if I'm ahead of the game, I'm out. And I never look at it like, I should have waited a day. Yes, in the beginning, a long time ago when I first started trading, I used to think that way. Like, God, I should have held on to it. I should have. No, I've learned from then, no. When you say you're going to get out, that's most likely the best place to get out. It may go against you for a couple of days. Forget about it. Never look back. If I can give you any other, if you can take anything else away from that, when you cover a profitable trade, never look back. All right. And one other thing from that is when you've had a loser, never try and go back there and fight to get that money back in that stock. I lost $500 in Apple. I'm going to trade till I get that money back. Forget about it. All you should be thinking about is the probabilities beat me. The probabilities are my favor going forward. Boom. Drop the mic. And that's all I got. All right, you guys. Take care and happy trading. Take advantage of this because I'm on every day sending these out, talking to them. All right. Take care, guys.